This is question 2 of paper 1. So for the first transaction, you have to identify which are the accounts that are affected. In this case, the owner is selling off personal investments and depositing it into the business bank account. So in this case, he is making a capital contribution. Alright, so you know that your capital will increase by $23,000. Alright, he is placing the money inside the business bank account. So cash at bank is under asset, and this goes up by $23,000. Now, when you are supposed to show the effects, you must ensure that you show the plus or minus sign. Okay, it is not enough to just show the account and the amount. You must also indicate the signs. And if there is no effect over here, you either write nil or you write no effect. Next one, you bought $500 stationery on credit. When you buy stationery, please note that stationery is not an asset. So you shouldn't see stationery under here. Alright, and you bought it on credit from Max Trading. We are not buying goods because goods is supposedly the furniture. Okay, so this cannot be trade payable, this must be other payable. So what happens is that you now have an other payable, and you must write the name of the supplier. So your other payable will increase, okay, your other liability will increase. Your assets has no effect over here. Now when you buy stationery, your stationery expense will increase. Alright, so I'm going to write stationery expense. If the stationery expense increases, this will cause profit to decrease. If profit decrease, your overall equity will also decrease. Alright, so stationery expense is the one that causes equity to decrease by $500. Please note that stationery expense is not decreasing by $500. Stationery expense is causing equity to decrease by $500. Alright, next one, we sold damaged goods costing $55 for $12 cash. So what happens here is that your inventory is decreasing by $55. Alright, and then the business will receive cash in hand of $12. Okay, so over here, when you sell goods, your equity will be affected because your costs of sales will increase, right? Your expense will increase, and this will cause your equity to decrease by $55. Your sales revenue, which is $12, will cause your equity to increase by $12. Alright, so next one, part B, you have to explain what is the residual value. Okay, in this case, what you must say is that the residual value refers to the estimated amount that a non-current asset can be sold for at the end of its useful life. For credit purchases, you have to say that goods are first received by the business. This is part 1. And then what happens to the cash? Okay, payment for them is made at a later date. Please note that the question is asking for credit purchases and not for credit sales. The last question is to explain consistency concept. This refers to the accounting methods used by the business must be consistent from one period to another. Why? Because we have to ensure that financial performance can be compared meaningfully.